So the basis of share valuation, what the writer says over here, common mistakes investors think that buying quality companies is all that matters and the price paid for the shares is irrelevant. Nothing of this sort. The price matters. How do you buy, or you're a long-term investor or a not long-term investor? The fair value of a share. To do this, you need to estimate how much free cash flow from operations minus capex, the company will produce for its shareholders for the rest of the life, and put a value on today's money, which is known as present value. This approach is called discounted cash flow. Now, internet is filled with so many examples, so many videos. How do you do discounting cash flow, and what is the biggest problem with the DCF is it has a lot of estimates. So estimate free cash flow for the year per share for a period of future years. Most analysts would try and forecast 10 years. He says, I assume Domino's can grow at 10% for a year for 5 years, and then the growth rate declines 1% every year to reach 5% at the year of 10 years. See, keyword here is I assume. Every assumptions can be different. Choose what interest rates you want to receive in order to invest, and this can be your discounting rate. You want to grow at 10%, 12%, 15%, so on and so forth. Estimate what value of shares might be in the 10 years. This is again estimations, which is free cash flow divided by interest rates minus long-term growth rate you want to get. So this is a formula, this is an example which the writer says and mentions over here. Then he says, I have shown you the number. You have to multiply the forecasted free cash flow. Forecasted, again a big question mark, to get a present value of the interest rate at 10%. The lower the interest discount rate, the higher the present value, and vice versa. See, in the DCF model, you can do Excel modeling and you can play around with the numbers. You reduce the interest rate, your numbers change. You increase the interest rate, your numbers change. Your forecasted cash flows can be very different, which the company might deliver going ahead. So forecasted cash flow per share for year 1 was 13.6, 15, and it is growing at 10%, and after 5 years it is growing less. The growth rate is dropping by 1% every. So he is discounted this by 10%, 10%, 10%. You get the present value, then you get a terminal value, and the terminal value you assume that the group company will grow at 1%, 2%, and you get to all this. We'll talk about DCF more in detail in the group. Domino's can't grow as fast in the future. That is why the profits. What if 10% grows? Discount rate is wrong. Then he says, I use the factor of 8%. Somebody can use a 12%. So answers would come very different. So risk mainly comes in the form of high debts. Company size, a smaller company tends to go bankrupt because of high debt. So this is the 8% thing which he has shown in the above example. So then he says, expectations of future profits move up or down. This can also be very dicey because we don't know the future. We cannot predict the future. Interest rate changes lower the rate trend to push up the share prices, and higher the interest to push down the share prices. So again, you can play around with the model, and your valuation can come very different. Then he says, don't use PE ratios because PE ratios are share price dependent by earnings per share. EPS is very manipulative. The EPS can be boosted by changing accounting policies. For example, the useful life of a fixed assets of the plant and machinery can be reduced or maybe increased. So if it is increased, suppose the depreciation is 5 years. In the 5 years your plant and machinery gets to zero. Then you say no, it will get to zero in 15 years. So depreciation will go down and your profit will go up. So don't use PEs, he says, because EPS is a very easy to manipulate. Then he says EPS says nothing about the quality of the profits. Share buybacks will boost EPS by shrinking the number of shares outstanding, even if profits are static or shrinking. Buybacks can be done with shares are expensive also, when the shares are cheap also. But when the shares are expensive, it is bad because the management is destroying value. The stock market is in a buoyant mood and the shares are very high, and this is the time at 20 times earnings despite non-existing growth prospects. And the example of Bob, which he says he keeps, and before the buyback and after the buyback, what can be done and how the numbers dance around. The companies like all this, the same example. Okay, then he has given you shares issue, true value per share, shares issue, value for business, buyback, and how the things change. So he says EPS may not be a very reasonable true cash profit. Often the company's true cash profit, which is your, you can call it as a free cash flow, are significantly more or less than the EPS. Then he says EPS may be based on profits that are unstably high or temporarily low, because some other expenses could be there and EPS could be low for 1 or 2 quarters, then it could revert again, and your assumptions of PE can be distorted. See, no science is perfect in stock market. Your DCF also has got a lot of assumptions. Your valuations on PE ratios are got a lot of assumptions. So the thing is, don't be very reluctant on a magic formula. There is no magic formula to value a business. This is what the author says in chapter number 9, the basics of share valuation. So these spoke about cash profits. So basically cash profits are your profit plus your depreciation, because you don't make a check or pay out a check of depreciation to anybody. You add back depreciation to your profit and it comes to your cash profit. So the next chapter is how do you calculate cash profit. So free cash flows may not be the best measure of a value in companies. You need to know the cash profit. Basically the cash profit is adding back depreciation or other non-cash charges which you are not paying out, but you are deducting it in your P&L. Then he says you just have to make sure that the free cash flow number you are looking at are reliable indications of the company can produce every year. Just as a company's management can manipulate profit, they can even reduce or manipulate their working capital or their capex. See, they can reduce their capex, stop investing in new assets, your cash profit would be high. Reduce working capital boost a company's operating cash flow. However, the boost might not be permanent. It might confuse an investor thinking that the company's sustainable cash flow is higher than it might actually be. So then he takes a fictional company's example. What these guys doing, he is reducing the amount of finished products and spare parts held in the stock. Means his godown, his showroom, this has been running at 20% of annual sales. The new target is 15%. So money getting released in inventory, so his cash profit will go up. Get customers to pay quickly. Trade debtors and paid invoices at the year have been around 8%. The target is set to 7%, which is good. If he does that, delay paying company supplies from 15% to 17%. Basically, these 3 points are your working capital adjustments, what he is trying to give. Then he is giving you some examples. How is this done? Working capital changes over here. Then he says customers are complaining that they can't pay any faster without putting themselves into financial difficulties. This is also a problem. So why would your customers pay you fast? Because if you give them a cheaper price, then they can buy from you. So this is all there to it, and this is the formula: net income plus depreciation and amortization plus other non-cash charges minus maintenance capital expenditure. Now the biggest problem is you don't know what the maintenance capital expenditure is. He also says if a business needs extra working capital, more stocks and more generous credit terms, we should add that also to your calculation of owner earnings as he has calculated above. The hardest part is you're trying to estimate maintenance capex. No, there is no way you can know because companies don't tell you nowadays. So there are 3 ways he has discussed. Company tells you what is my maintenance capex. Wow, if it is that, then very good. Or use a multiple of current depreciation, say 120%, 125%. You are adjusting for inflation, just an estimate. Or use a 5-10 year average of the capital expenditure of the capex. See, we are not looking at the average now because your capex will include your growth capex as well as your maintenance capex. We just need the maintenance capex. Companies and cash flows have a poor track record. Modest ROC, CROIC, which we have read above, are not good, as he says. So these are different companies, different capexes, the 5-year averages, 10-year averages. So he is doing the companies. Take a company's most recent annual underlying normalized income, add back depreciation, amortization, take away estimate of business capex, divide the weighted average number of shares, and you get the cash profit per share. More examples. Now we have the cash profit here. Now we can move on to see how do you value these companies. So the next is using cash profits to value shares.